The year is 2008. A family in California sits at a kitchen table staring at a letter from their bank. Their monthly mortgage payment, once manageable, has suddenly doubled. Across the country, the same scene plays out. Houses go dark, streets empty. Entire neighborhoods begin to collapse, not from fire or flood, but from something abstract. On Wall Street, screens flicker with a different kind of panic. Mortgage-backed securities are now impossible to price. Banks stop trusting each other, lending freezes. Trillions of dollars evaporate in weeks. This isn't just a housing crisis, it's the failure of a belief. For most of human history, a house is a place to live, a shelter, a necessity. But somewhere along the way, housing becomes something else entirely, a financial asset, a wealth-building machine. How does a basic human need transform into the engine of global finance? What happens when stability becomes instability? This is the story of when America decided housing wasn't a right to be secured, but an investment to be optimized. In the aftermath of the Great Depression, the United States faces a broken housing system. Banks collapsed, foreclosures rampant. Homeownership was out of reach. Mortgages were short-term, high risk, requiring large down payments. Few could afford them. So the government intervenes. Through institutions like the FHA and Fannie Mae, housing finance is redesigned. The new model is elegant. Mortgages are stretched over 30 years. Risk is reduced. Monthly payments become predictable. The promise is clear: stability, accessibility, and the democratization of homeownership. And it works. Home ownership rates surge. Suburban America expands. A house becomes more than shelter, a symbol of stability. But embedded within this system is a subtle shift. A mortgage is not just a loan, it's a financial product. If you can standardize financial products, you can package them. If you can package them, you can sell them. This is where the transformation begins. Think of a mortgage as a stream of future payments, like paychecks. If you bundle thousands of these streams together, you can create something new, a mortgage-backed security. Imagine 1,000 homeowners paying their mortgage every month. A bank bundles these loans and sells the right to payments to investors. The bank gets cash up front. The investor gets a steady income stream. It's efficient, scalable, and appears safe. The system frees up capital, allowing banks to issue more loans. Housing becomes more accessible. Credit flows freely. But the moment mortgages are turned into securities, the incentive structure changes. Banks are concerned with selling loans. Housing is no longer just about shelter, it's about yield. The idea spreads rapidly. By the 1980s and 1990s, Wall Street refines the model. MBS evolve into more complex instruments, CDOs. These are bundles of bundles, sliced into layers of risk. Top layers are safe, bottom layers absorb losses. Rating agencies assign high credit ratings. Pension funds, insurance companies, global investors pour money into them, attracted by returns that seem both high and secure. The system scales globally. Here lies the central paradox. The system designed to distribute risk begins to concentrate it in ways no one understands. For all its complexity, the entire structure rests on a single assumption: that housing prices will continue to rise. If prices rise, defaults are manageable. If prices fall, the entire structure begins to crack. To keep the system growing, more mortgages are needed. But there's a limit to qualified borrowers. So the definition of qualified begins to expand. Subprime lending emerges. Loans are issued to borrowers with poor credit histories. Adjustable rate mortgages offer low initial payments that later reset. Documentation requirements weaken. At every step, the logic is justified. Housing prices have never fallen nationwide. Risk models built on historical data reinforce this belief. Investors trust ratings. Banks trust models. Borrowers trust the system. But the flaw is not in any single component. It's in the assumption that the system itself is stable. To understand the mechanism, imagine drawing it on a whiteboard. Start with the homeowner. They take out a mortgage from a bank. The bank doesn't hold the loan. Instead, it sells it to an aggregator. The aggregator bundles thousands of these loans into a mortgage-backed security. That security is then sliced into tranches, layers with different levels of risk and return. These tranches are sold to investors around the world. Now add leverage. Investors borrow money to buy more of these securities, amplifying both gains and losses. Then add derivatives. Instruments like credit default swaps allow investors to bet on whether these securities will fail, essentially creating insurance contracts that multiply exposure without creating new underlying assets. At each step, the connection between the homeowner and the investor becomes more distant, more abstract. The system appears diversified. In reality, it is tightly coupled. A default in Nevada is connected to a pension fund in Europe, a hedge fund in New York, and a bank in London. The plumbing is global. The vulnerability is systemic. The catalyst arrives quietly. In 2006, housing prices stopped rising. Not crashing, just plateauing. For a system built on perpetual growth, this is enough. Adjustable rate mortgages begin to reset. Monthly payments increase. Defaults rise. As defaults increase, the value of mortgage-backed securities becomes uncertain. Investors no longer trust models. Ratings lose credibility. Liquidity disappears. Banks, unsure of each other's exposure, stop lending. The interbank market freezes. Then comes the chain reaction. Major financial institutions collapse or require bailouts. The global financial system teeters on the edge. The algorithm processed billions in milliseconds. Foreclosures take years. The economic scars last decades. Today, the system looks different, but the underlying logic remains. Housing is still treated as an investment, often more than a necessity. Institutional investors now buy single-family homes at scale, turning neighborhoods into portfolios. Real estate investment trusts and private equity firms treat housing as a yield-generating asset class. New financial instruments extend the same principle, turn physical assets into tradable financial units. The modern thread is clear. Whenever a basic necessity is financialized, it becomes subject to the logic of markets, optimization, leverage, and speculation. And the same questions reemerge. What assumptions are being made? Where is the risk actually concentrated? Who ultimately bears the cost? These are not abstract questions. They are the blueprint for understanding not just housing, but every modern financial innovation. First, identify the incentive structure. Who profits from creating the asset and who holds it long term? Second, examine the assumptions. What has to remain true for the system to work? Third, trace the connections. How widely is the risk distributed, and how tightly is it linked? Finally, ask the most important question. What happens if the underlying asset stops behaving as expected? These are the blueprint for understanding the architecture of the world you live in. The invisible systems that turn homes into assets, risks into products, and stability into something that can be traded. Because once housing becomes an investment, it stops being just a place to live. It becomes a bet, and every bet eventually is tested.